Now, another issue with regard to sale of the business has to do with the tax consequences of the purchase and the sale. So you agree to buy George's business for $500,000. Okay, so the deal is he gives you the business, you give him $500,000. Well, the deal is not done yet because you still have to negotiate the details, and one of the details you have to negotiate is how is that $500,000 purchase price going to be divided up between the different assets of the business that you are buying. So how much of the purchase price of $500,000 will be allocated to the purchase of the equipment? How much will be allocated to the purchase of the inventory? How much will be allocated to the purchase of the business goodwill or the trade name or the trademark? And these things are very important because the allocation of the purchase price, if it's done one way, it maximizes tax benefit to the buyer, and if it's done that way, it may minimize tax benefit to the seller, and vice versa. The tax allocation, the purchase price allocation that has the best tax consequences for the seller may have the worst consequences for the buyer. For example, if you're allocating the purchase price between the business goodwill, that is, the reputation built up within the community and the establishment of the brand name and all that, you're allocating part of the purchase price to goodwill and another part towards inventory and equipment. The seller is going to want as much of the purchase price allocated to the goodwill as it can, and as little to the allocated to the equipment and inventory as possible, because when the seller gets that money, the money that comes in that's for the goodwill, he can classify that as capital gain, and he will pay a lower tax rate on that. But the money that comes in for the equipment and inventory will be classified as ordinary income, and he will pay a higher tax rate on that. And in fact, he may have already depreciated those assets, and he may have to recapture some depreciation and pay a higher tax rate yet on that. So the seller wants the maximum amount possible allocated toward goodwill, and the minimum amount possible allocated toward equipment and inventory. Buyer wants just the opposite, because he can take that equipment and the purchase price allocated to the equipment and inventory, and he can depreciate that over time and reduce his taxes. So you've got to negotiate out how are we going to split up and allocate the purchase price, and you need to talk to an accountant or a tax lawyer to help you strategize and work that out before you make the final agreement on the purchase price and how it's going to be allocated. Another thing that you want to be sure to do if you buy a business from a single owner or a small group of owners is to purchase a covenant not to compete. Now, we talked about covenants not to compete earlier in the course, but in case you don't recall, although covenants not to compete are not legal in California with regard to an employer forcing employees to sign one, covenants not to compete between business owners, between the buyer and the seller of a business owner, those are okay. Those are legal and enforceable as long as they are limited as to geographic area and as to time period. So if you bought George Smith's computer company, you could have a covenant not to compete, which you paid him a certain amount of money for, that says George Smith will not open a competing computer company anywhere in the Rockland, Roseville, or Sacramento area within the next 2 years. And that would be a legally enforceable covenant not to compete, and it can be very, very important because sometimes George Smith sells you his business for $500,000 and he retires to the beach in the Caribbean. He lays down there on the beach drinking Mai Tais for 2 or 3 months, and then he is bored out of his mind, and he misses all of the adrenaline rushes of being in charge and having a business and being at risk. And he comes back to Auburn or Roseville, and he wants to be in business again. And the only business he knows is the computer business. So he opens up a competing computer business right down the street from yours, and he calls all his old customers and says, "Hey, come back." Well, you paid him $500,000 for that business and his customers, and you're not going to be happy about that. But if you have a covenant not to compete, then he cannot do that. At least he cannot do it in the Rockland area for the next 2 years, and by then you're either established or you're going to be hurting anyway. So that gives you enough protection, and it doesn't render him totally unable to operate a computer business anywhere in the world. It just says you can't come back and do it across the street. You got to go do it somewhere else, or you got to wait a couple of years. So that's the covenant not to compete. Probably the last and most important thing to talk about in the sale of a business is the fact that usually the buyer comes in and he cannot pay you the entire purchase price in cash. If you can get a buyer to pay you cash, even if they're going to offer you a lot less money than what you could get if you finance a part of the purchase price, take the money and run. Because the single most frequent cause of ugly, nasty, disastrous, and expensive lawsuits between the buyers and the sellers of business is when the seller finances a part of the purchase price. So let's look at this for a minute from two different sides. First of all, if you are the buyer of the business, even if you are so wealthy that you do have the ability to pay all cash for the business, you may not want to do that. There may be strategic reasons why you want to go ahead and ask the seller to finance a portion of the purchase price anyway. Why? Well, if you give the seller all the money and then he retires and takes off to the beach somewhere, that's the last you're ever going to see of him, and it's the last of the help you're going to get from him, and he doesn't care whether you succeed or fail, because he's no longer at risk in your success or your failure. He may not bother to get you adequately trained before he leaves. He may not bother to introduce you to his best customers or his suppliers, people that help him with the business, his lenders. He doesn't care whether you succeed or fail because you gave him all the money and he's gone. If, on the other hand, however, you pay him a certain percentage, you pay him 10 or 20 or 50% down payment, and you sign a promissory note and make payments to him for the balance, now he's at risk. If you don't succeed, he doesn't get paid. And so before he leaves, he's going to make sure you know every trick in the book of how to be successful in that business. He's going to take you around and introduce you to all the customers. He's going to introduce you to his suppliers. He's going to do everything he can to make sure that you succeed, because if you don't, he may never get the rest of his money. So there's a good strategic reason as a buyer. Of course, there's also usually you don't have enough cash to pay all cash. And secondly, even if you did, you want to have a big cash reserve. The bigger cash reserve you have, the more likely you are to make it through that first 2 years of tough up and down times when you're learning the ropes of the business. But assuming that even you had enough cash and you had enough reserve, you might still want to ask the seller to finance a part of the purchase price, because that maximizes the effort he's going to put into making you successful. The classic lawsuit, however, the thing that happens the most often to create ugly, nasty lawsuits between the buyer and the seller is the buyer comes in, he looks at the books of the business, and he sees, wow, every month for the last couple of years, this guy's brought in $20,000 a month in sales. This is awesome. I'm going to buy the business from him, and I'm going to put in all my new clever ideas, and I'll be making $30,000 a month in sales, and so everything's going to be great. And so he gets in there and he implements all of his new ideas, and there's stuff that, as the seller, you tried 20 years ago and they didn't work, or maybe some of them do work, but some of them fail miserably. And also, he doesn't know how to cut all the corners, and he loses some of the old customers who only came there because they like you as the seller. And he gets in there and he finds out, wow, that guy's books, the seller's books showed he did $20,000 in sales every month. I haven't done $20,000 in sales since I've been here. I've been here 6 months or a year now, and I've never done better than $10,000 a month. And I was counting on at least $20,000 a month to be able to generate enough profit to pay all the bills. And so he's hurting for money, and his cash reserve begins to run out, and he looks around and he sees, wow, I don't have enough money to pay all the bills this month, and if I don't pay the employees, I'm out of business. And if I don't pay the rent on the building, I'm out of business. Where can I cut a corner? Oh, the monthly payment I owe to the seller. Well, I just have to skip the monthly payment this month, and I have to owe to the seller. And, then he thinks about it, and he's getting behind 1 or 2 or 3 months in the payments to the seller, and he's still hurting for money, and he's thinking about it, and he's saying, that seller must have cooked his books and lied to me, because there's no way he could have been making $20,000 a month here. I have never been able to make more than $10,000 a month. He must have defrauded me. And about that time, the unhappy seller shows up and says, hey, you haven't made a payment on your loan for 3 months. If you can't make a payment, I'm going to have to sue you to repossess the business. And then the buyer says, don't you dare try and sue me to repossess this business, and I'm not making any more payments to you anyway, because you defrauded me, because you said this business makes $20,000 a month in sales, and I've never been able to make more than $10,000 a month in sales here, so I'm sure you cooked the books and defrauded me, and I'm going to countersue you for fraud. And then it begins. Horrible, nasty, expensive lawsuit. So much damage and money is lost in the legal fees. Nobody usually wins that thing but the lawyers. Sometimes the seller's lucky and gets his business back, and sometimes by the time the seller gets the business back, if he gets it back at all, it's pretty much sold out to the bare shelves and destroyed. Customers are lost, and you get back a worthless piece of paper. So keep in mind, the single most frequent cause of disastrous lawsuits between the buyers and sellers of a business is the seller financing the purchase price. And when you are at the seller and you're looking at how much of a down payment the buyer is offering you, think to yourself, okay, if this is all that I ever get from the business and I have to walk away and not get the rest of it, is that enough? Am I going to be okay with that? And what if I have to repossess the business and start it all over again? What if it gets sold out down to the bare shelves by a failing business owner, and when I finally get it back, there's next to nothing left of it? Am I going to be okay with that? Those are considerations that you should take into account when you're deciding whether or not the down payment that the buyer is offering you is large enough, and whether or not you really want to finance a major portion of the purchase price. Okay, so the last thing about seller financing, make sure that you get the hard assets of your company as collateral pledged for the loan, and not just the stock certificates, which may end up being a worthless piece of paper. And also remember that in order to have the right to repossess the assets of the business, if there's a bankruptcy, and to beat even the bankruptcy trustee, you must be a properly perfected secured creditor. And in order to be a properly perfected secured creditor, you must have a written and signed promissory note from the buyer of the business. You must have a written and signed security agreement which pledges the assets of the business as collateral for the loan. And you must have a signed UCC-1 financing statement filed with the Secretary of State's office in the state where the business is located. If you have those things, then you're a properly perfected secured creditor. And if the buyer fails to make his payments, you have the legal right to repossess the assets of the business, even over the claims of a bankruptcy trustee. Okay, that's it on the sale of a business.